All right, we're going to get started here. First, I just want to thank you all for taking some time out of your day. It's a Monday. I know how busy Mondays are. It's 4 o'clock. You're probably itching to get home or itching to do something more exciting than listen to my commentary. But I think there's a lot of exciting things going on out there, and I found some great charts and pieces to support today's discussion. For those of you who haven't joined us in the past, just a reminder that all of what I'm sharing with you are my opinions and what I surmise from various pieces that I've read and charts and so on, and that this is being recorded and this will be distributed to others who are not joining us today. We will save any questions or comments until the end, and I'll open it up for everybody to speak. But if you could please keep yourself on mute until I finish my commentary. The commentary was pre-written. I have to write that and submit that to compliance for approval. I will deviate from that from time to time, but I have to do my best not to do so. But I do look forward to any comments and any questions you might have as I conclude. I estimate that the presentation will be a little bit longer than usual. It'll be about 45, maybe 50 minutes. And I will do my best to make sure I explain some of these charts in as much detail as possible. So with that, let me get started. First and foremost, if you can see here, you'll see a little bit of a difference in our branding. This is our 25th year. I pinch myself. I turned 50 in December and celebrating now in January 25 years in this industry. And thank you to every one of you and to even, of course, the folks who aren't joining us today. We would not be here without you. And we sincerely would just want to express our appreciation, our thanks. Every one of you have made us better at what we do, and we look forward to continuing to grow and do a better job for you and for others that we serve. Let me now jump into it. So coming into 2022, as usual, nobody really knew what to expect. And we were coming off of a rather chaotic and exciting 2 years in the markets, and people had all but gotten used to having a great double-digit return in their portfolios. And we began all of our analysis in December of 2021 and into January of 2022, reviewing all the different resources that we have access to in order to help get our arms around what 2022 might look like. And no matter what the resources, it is still anyone's bet as to where things might end up for the year. Our effort is to ongoingly focus on opportunities that present with a pretty strong risk reward. While the evidence was clear that several asset classes were overpriced and destined for correction, that same clarity has existed at the beginning of many years where one would be filled with regret for having left that asset class behind. 2022 proved to be one of those years we all wish we could turn back and make different decisions. Our analysis is based on the analysis of many reputable firms whose research and analysis we have grown to find great value in. Many of the charts and information that you have seen in the past presentations and in this one come from those very firms. And dozens of firms with a national reach come out at the end of each year and make predictions for where they see the upcoming year finishing. The blue dots in this chart we see and their predictions for 2022. So again, the blue dots in this chart we see here represent some of the biggest names in the industry and know what their predictions were for 2022. And as you can see, that range was rather significant. The predictions we see are almost always related to the equity markets. Rarely do we see as much attention paid to the bond market. And at the end of 2021, it was really about the same. However, 2022 certainly proved the year of the bond. If one were lucky enough to take a dive into less traditional bonds, such as floating rates, they ended up in a pretty good spot. But for those who had the misfortune of holding or buying nearly any other bond position, they suffered the worst losses in history for what was intended to be a conservative part of their portfolio and be a life jacket for a sinking ship, proved to be a major contributor to the downside volatility of their portfolio. Going back to 1928 and looking at the performance of a 60% stock and 40% bond portfolio, 2022 was the second worst in history, with the end result of negative 18%, not including expenses. Assuming the typical fund fee of 1% and the typical management fee of 1%, mathematically, it would be easy to see a conservative portfolio of this type being down a whopping 20%. If you scan this chart, you will see that there have only been 4 previous years in which all 3, the S&P 500, the 10-year Treasury, and a 60-40 portfolio performed negatively. Absent the horrific 1931 market conditions, 2022 proved to be the worst in history for this combination. Now, if I can draw your attention to the 10-year column in each of these 5 groupings, you will see that the worst year on record prior to 2022 for the 10-year Treasury was not 1931, but it was the year 2009 with a negative 11.1% return. 2022 raised many eyebrows as we finished with a nice positive run, bringing the 10-year Treasury in at negative 17.8 from what was nearly a 20% loss in this conservative investment. Keep in mind that this is during a period when interest rates are on the rise and treasuries are yielding more. This helps us to recognize the incredible adverse relationship between increasing rates and treasuries as well as bond values. Every year comes with volatility, and this chart represents that well. Interesting, 2022 finished well off its bottom in the S&P 500, where it had at one point marked a 25% loss. This number here is representing the bottom during the year. We were down as much as 25% last year. Going back just 2 years to 2020, we experienced what you can see here in the red, a negative 34% loss, only rebounding to a solid 16% gain. Here you see the 16%, so where the year finished. In the midst of that 34% decline, I think every one of us would have been happy to finish that year down 19%. But we got pretty lucky and finished at a plus 16. Short-lived was that downturn, as was our memory of what was truly a torturous period in all of our lives, not just because of our portfolios, but because of what our world had come to. If the world financial markets had continued as many expected they would in early 2020, coupled with the health crisis we experienced, I believe we would have suffered far greater than we did. While it seems obvious from nearly every financial report and prediction, I'm not so sure that where the year ends, so too should our confidence. The end of the year does nothing more than mark a new round of holidays and birthdays. Other than marking the end of most tax planning opportunities, there is nothing of substance that year-end brings for our portfolios. I guess we need to mark the end and the beginning of performance periods somehow, but the reality is that every rolling 12-month period is important in your portfolio. Clearly, 2022 ended with a fizzle that none of us desired and led to many having concerns about their financial future, a substantial decrease in confidence versus a year earlier as well. How can one have any confidence when every report from every media source is negative, not just on the markets, but in nearly every single area of life? The NBC nightly news is a short 30 minutes, but most nights you have to hang on to the end until after the very last advertisement to see what's often less than a 1-minute positive in the news. It's understandable why so many people have such a negative outlook, and I refuse to be a part of that growing crowd. While December brings the close to the year, it's nothing more than that when it comes to managing your money. We want to consistently be looking at the positions that make up your portfolio to determine what should be held, what should be watch listed, what should be replaced and added based on the risk and the reward that each opportunity presents. No matter what point we are in the year, this is always important. You may recall that in my last quarterly commentary I presented in October, and I explained how October has always been a special time of year. In upstate New York, we welcome the fall season with incredible views from our office, but it also happens to be the most common month for the bottom to be reached in the markets. The Dow Jones, the S&P 500, and the NASDAQ index have all seen far more market bottoms in the month of October than in any other month. And if things hold, we will be able to add one more to that to the 3 bar charts in October, as we saw the most recent bottom in October of 2022. Now note that we may have seen the bottom of the NASDAQ and the Dow just a few days before October started, right at the end of September. All right, let's turn our focus to 2023. Here we are, again, hearing all the predictions and the various commentators talking about the markets and where they see things going. In the last few weeks, there have been endless headlines relating to the markets, from very positive to very negative. And here's just a few of them. Bank of America predicting a bad market for U.S. technology, for private equity, for the U.S. dollar, and for emerging market equities. Piper Sandler suggesting that the stock market will not be good. BlackRock and Fidelity stating that investors are underestimating inflation and interest rates. And Stifel is suggesting the strong first half and the S&P 500 rising over 17% by the second quarter. So what's an investor to think? What's an advisor to do? We have to ignore all the noise and focus on your goals. We have to understand your needs over the next couple of years and ensure that your portfolio's ability to meet those needs at its current value and risk level. When you are taking your last breaths on this earth, it will not be your rate of return in any given year that allows those breaths to be taken with financial dignity. That financial dignity is a key ingredient in our recipe for your success. Our annual custom wealth inspection meeting, where we demonstrate where we projected you would be in order to stay on track towards your goals and compare that to where you actually are, is the foundation of your long-term success. Couple this with the Monte Carlo analysis that we do, and we have an immediate gauge where things are today, where they are headed, and what we can expect your future to look like. Let's turn to this year's list of predictions for where the S&P 500 will be at the end of 2023 from 17 different institutions. Deutsche Bank is predicting roughly a 15% increase for the year, while BNP is predicting the polar opposite with a 15% loss for the year. So again, we saw these predictions a few minutes ago for 2022 and how far off they are. Here we are looking at 2023. Deutsche Bank predicting about a 15% increase, BNP predicting about a 15% loss. Who do we believe? Why do we believe them? Do we adjust everybody's portfolio to align with that belief? Do we discuss your beliefs and adjust the portfolio accordingly? And as we saw from the predictions that were made back at the beginning of 2022 and the actual results, our answer should be none of the above. We continue to manage your portfolio by evaluating every underlying position. How much is in that position, why we own that position, whether we should have more or less in that position based on your savings rate or withdrawal rate, and so on. There will be positions we're not happy with from time to time. And 2022 is a great example where we had two core positions that underperformed substantially. While the end of December put these two positions in the book in terms of their return for the year, January was just around the corner and delivered already a double-digit return for both of these positions. Hindsight always tells us what we could have done, but never what we need to do. And I want to say that again. Hindsight always tells us what we could have done, but never what we need to do. What we should do is based on present-day assessment, manager discussions, asset class analysis, and truly brave decision-making. While we had two core positions that underperformed in last year's horrendous market, we had eight core positions that substantially outperformed. An 800 batting average or an 80% success rate in any sport is very strong. And we're very pleased with this result, given the market environment that we endured together with you in 2022. There are a lot of things that we look at in determining the positions that you own. One of those is the valuation or the price to earnings ratio of the underlying asset. In this slide, we see that the S&P 500 has seen valuations increase to 16.65 since our October presentation. And those valuations are now in line with the 25-year average of 16.82. While this alone should not lead us to determine how to position your portfolio, it is one indication that the current US markets are pretty fairly priced. The box at the top of this chart shows a nice comparison of several other aspects of the S&P 500. And interestingly, we are in line with the 25-year average in many areas. I'll spare you a lengthy presentation on each of these, but what's important to take from this is that the S&P 500 is not inexpensive today, suggesting that a strong US bull market is likely not just around the corner. The previous slide gave us a 30,000-foot view, and this slide really gets down to the 1,000-foot view. And let's start over on the right-hand side. Here we see in the top left of each box, like this one here, this 21.1, excuse me, that's the top left of the box, the current valuation of the applicable asset class. So large cap growth is trading at about 21.1 times. Just beside it is the 20-year So the 20-year average is 18.6. And you can clearly see that large cap growth is trading pretty expensive versus the 20-year average. If you come down here at the bottom, this chart's a little bit easier to read. We're trading at about 113% of our 20-year average from a price to earnings ratio in large cap growth. 102 in value, 103 in mid growth. Interesting enough, 71.2 in small growth. The remaining asset classes are pretty well undervalued: mid value, mid growth, small value, small blend, and small growth. This may lead one to think that we should put the brakes on those overvalued asset classes and overweight to the undervalued. More on that in a few moments, but let's turn to the left side of this slide. Looking at large cap growth over the last decade, it was far and away the best asset class with a whopping 14.1% annualized return. This is the 10-year, 14.1%. If you started your portfolio with equal amounts in each asset class, you would have seen that part of your portfolio swell to a very disproportionate allocation in your overall portfolio. The problem with that is that you never know where lurks the correction. As an example, if you start with $100,000 and you have that 14.1% gain each year for 3 years, what's the value of your portfolio? It would be about $150,000 after compounding for that 4-year period. If in the 4th year you lost 29.1% like we did in that asset class last year, how much would you have? You would actually be just about back even with about $106,000. That would mean that after that 4-year period, your gain would have been about $6,000 or 1.44% a year. Not very good. To repeat a point that I made earlier, hindsight always tells us what we could have done, but never what we need to do. All right, valuations be what they may, money supply is another important aspect of market conditions. And as we saw in 2022, with the tightening of money supply as a result of the Fed's increasing rates, we saw a turn of events in the stock market and in the bond market. The good news is that most expect the Fed to slow its rate increases and potentially even start to soften later this year or in early 2024. Now, in most years following the Fed's decision to increase rates, we have seen fairly positive results. 1994 is the only year you can see in this chart where we experienced a negative result post the Fed's decision to increase rates. There's more good news when it comes to value investors. The S&P 500 is made up of 2 primary asset classes, value and growth. In general, value stocks tend to be companies in the healthcare industry, financials, industrials, consumer staples, materials, energy, and utilities industries, while growth stocks tend to be companies in the information technology, consumer discretionary, and communication services. A few moments ago, I explained how all large cap stock sectors are overvalued versus their 20-year average. On the large value stocks, the current valuation comes on the heels of a long period of growth outperformance, making value the least expensive it has been since the early 2000s. Look closely though, because we did see a bounce like the one that we are seeing now back in 1998, before growth skyrocketed again and value became excessively cheap. Then, of course, the bottom fell out of the growth sector in the tech bubble. Now, just a few moments ago, we saw how large cap growth suffered 29.1% loss last year, ending a 10-year run of 14.1% annualized returns. Large value stocks, on the other hand, had an admirable 7.5% loss last year instead of 29.1%. Here's yet another example of why we rarely leave behind an asset class when building your portfolio. We never know what will do well when it will do well, or for how long it will do well. Making 2022 even more of a rarity, it happened to be a year that we actually turned our back on an entire asset class for the first time in our 25-year history. More on that in just a moment. Continuing with some of the positive in the market and the economy, consumer confidence fell to a level we had not seen the likes of since the great financial crisis. We fell to about a 50 in consumer sentiment, but recently we've seen that rebound all the way to 60. Historically speaking, every significant bottom has been met with a strong market result over the course of the next 12 months. We are hopeful that consumer confidence will continue to rise and that this chart can keep the positive results from similar market environments dating back to the very early 70s. All right, let's get into a discussion on bonds. As we know, 2022 was perhaps a once-in-a-lifetime occurrence for bonds. Muni bonds were no exception. Often thought of as a safe haven for one's money, muni bonds experienced substantial outflows in all categories other than money markets. And depending on your portfolio mix of retirement versus non-retirement values, we retained exposure in munis as we have in past markets of similar nature. We see this as a temporary, given the extremely high default rates that these outflows project being far higher than even the default rates during the great financial crisis. With yields increasing very nicely, we expect to take a larger stake in these positions in the very near future. While we maintained our exposure to munis, we did entirely turn our back on nearly all other types of bonds, with the exception of floating rates, also known as senior loans. We were fortunate enough to reposition substantially in 2021 to these types of bonds. However, had we repositioned everything to those floating rates, we would have missed out on the run we've seen in January. Our floating rate position is up just over 1% as of this writing, while our muni position is up nearly 4.5% after being down about 14% in 2022. This chart helps to explain why. We have seen a nice squeeze on yields in the last month, with the 2-year, 5-year, and 10-year all experiencing a greater decrease in yield than the 30-year. Remember that typically where yield goes, performance does not follow, but tends to go in the opposite direction. So these decreases in yields over the last month have resulted in a nice positive jump in several types of bonds, including, again, the muni position that we've got in many of your portfolios being up 4.5%. I want to come back to munis just for a moment. We're seeing a nice spread between the tax equivalent yield on munis versus treasuries, as you can see from this chart on the left. That suggests that there could be a very strong market result for early muni investors. As the muni curves on the left-hand side realign to historical norms, the value of muni bonds will climb as a result. There is no clarity on the time frame for this, but over time, historically anyway, these curves have been much more in tandem. The chart on the right has actually no real place in my discussion today, but I thought you might find it interesting how the federal debt has changed over the years and currently rests just shy of where we were at the conclusion of World War II. State and local debt, on the other hand, are really in pretty good shape and have remained fairly consistent for decades. Unless you've been locked away the last year, you are well aware of what the Fed has done with interest rates. At the beginning of 2022, there wasn't a soul predicting such substantial rate increases in a short time. These increases were faster than they were in the dot-com bubble and the time leading up to the great financial crisis. Post the GFC, or the great financial crisis, we saw rates stay artificially low for quite some time until 2016, when we started to see some movement. They dropped quickly back to zero as a result of COVID and have remained there until early 2022, skyrocketing over the course of the year. Many expect to see the Fed soften its approach to a 0.25% increase in the first few Fed meetings, and then briefly pausing before starting to reduce rates as early as summer 2023. As you can see in the chart, the FOMC continues to maintain a long-term projection of 2.5%, and the year-end estimates and market expectations are plotted, showing their arrival back at 2.5% occurring over the next 2 to 3 years. There's really no better chart than this one to really see how dramatic of an impact the interest rate increases by the Fed have had on the marketplace. The lower line in this chart reflects interest rates for various time periods as of the end of 2021. And the blue line at the top represents the same for the end of 2022, just 1 year later. The gray area is the range of rates that we've experienced over the last decade. We went from a comfort of a normal yield curve in 2021 to a clearly inverted curve just a year later. Short-term interest rates climbed from 0.19% to well over 4% in just a year, while the long-term rates went from only 1.9% to 3.97% over that same time frame. This is a chart that I'll be excited to see change over the course of the next couple of years for sure. Let's go to inflation. If you were not aware of the interest rate increases, you probably were also not aware of the impact of inflation in 2022. Inflation is a combination of many areas of spending, as indicated in the colorful bar chart on the left side of this slide. If you look closely, starting at the bottom, the dark blue represents the cost of shelter, and it has clearly increased strongly over the course of the year. On the other hand, look at the sharp decrease in the cost of new and used vehicles in red. We saw a sizable jump in energy inflation in March, and that, of course, was the onset of the Russian-Ukraine war, but those costs have subsided as well. On the right, we see that the forecast for 5-year inflation based on professional forecasters and consumer expectations does arrive at a far more attractive 2.9%, which is in line with the Fed's goal for the interest rates at 2.5% that we just saw a few moments ago. Domestic inflation is one thing, but there's been a lot of questions about inflation overseas. And looking at the most recent charts for Spain, Italy, France, and Germany, things are looking a bit better as well. The value of the US dollar being reduced could have a very positive impact on this going forward. While nobody's been pleased with the level of inflation most recently experienced, sometimes it's refreshing to see how good we really have it when comparing to other parts of the world. You may not know this, but China experienced its lightest growth rate in decades in 2022, and is faced with demographic challenges that could lead India to soon take its place as the planet's manufacturing leader. China experienced only a 1.8% inflation rate last year. Now look toward the bottom of this chart, and you can see there are some clear countries that your retirement dollars will not nearly go as far as they would have a year ago. Turkey, Argentina, Venezuela suffered unimaginable inflation, and the impact of that will most certainly be seen on the news in the coming months. You may recall how excited I was in 2020 and in 2021 with a rather shocking level of household savings rates as they reached by far the highest levels ever recorded. The health of our economy is substantially influenced by consumption. Fortunately, we have seen that money go to use as people spent dramatically on goods, followed by services. We knew the old sensation of money burning a hole in one's pocket would come to a climatic end. And the level of personal savings has fallen well below the historical trend at this point. If we fail to see this rise in the near future, that does suggest that we may see an increase in consumer debt and defaults on that debt, for instance, credit cards. The good news is that we are very in tune with your finances, and the overwhelming majority of you have spent well within your means, and we do not suspect any great concern for those that we work with. However, as is often the case, those without the means to have excess income or savings will most likely suffer the grunt of this unfortunate circumstance. All right, let's take a few minutes to talk about housing. I remember very clearly the housing boom of the early 2000s that led us to the great financial crisis. People were buying homes as if they were a simple transaction like a bag of groceries, and banks were providing financing at an unsustainable rate. It was quite clear that we were in a housing bubble and that it would be a rather jarring correction. Interest rates during that time were considered quite low from a historical perspective, but as you can see from this chart, they were in the 5 to 7% range, which sounds very familiar to where we are today. The most recent housing bubble was far from the same. People left large metropolitan areas as the work from home atmosphere took hold, driving up prices in areas that have rarely seen the substantial value increases that big cities have experienced, including our area in upstate New York. Interest rates were low, and banks, having learned their lessons from the early 2000s, stuck to fairly strict underwriting guidelines. Personal wealth during this time grew dramatically as a result of the influx of government support and stock market growth. With interest rates climbing back to be more in line with historical norms, the housing market has cooled. However, we do not expect to see the crisis that housing experienced in 2008. The good news is that most people have regained the value that they paid for their home nearly 20 years ago, and we have more value in home equity than we have ever had. While we do expect to see housing continue to soften, we do not expect to see panic sellers driving those prices down substantially. In addition, it appears that we have a severe shortage of supply that should help with just a modest correction in home values. As I alluded to just a second ago, this chart represents the percentage of homeowners who have negative equity in their homes. This has dropped considerably from over 25% of homeowners a mere decade ago to less than 2% today. On the downside, homes have become far less affordable as a combination of interest rates and home values have created a burden for the buyer. We are at the lowest rate in nearly 30 years for home affordability. Existing family home sales have plummeted faster than ever on record, as represented by the red line in this chart. Keep in mind that this does not necessarily coincide with prices. It is only a reflection of the number of existing homes that have been sold. We suspect that this is not so much a lack of buyers as it is a lack of sellers. Let's take a closer look at this. Going back to 1982, we are seeing by far the lowest inventories of existing family homes. Referring back to the previous chart, a big reason for the substantial decline in existing home sales is a shortage of supply. People are just not interested in selling their homes. Combine this with the lower number of single-family housing starts on the top right and the low vacancy rates on the bottom left, and you may conclude, as I have, that there may be a housing crisis unfolding before our very eyes. The bottom right may be good news in some ways, as new multifamily housing starts are strong, but does that mean a stronger desire for people to rent versus own? There are two things to consider here: the aging population and whether they desire to rent as they age or own a home, and Gen Y, or more often referred to as the millennials. Their increased desire to rent, will it begin to dissipate as they have children? The future, as always, holds the answer to these questions. The US consumer is in relatively good shape. Household net worth has grown dramatically in the last 15 years, up nearly 100% since 2007. Assets to liabilities are quite strong, and the debt servicing ratio reflected in the top right chart is in very good standing. Had either of these been a concern going into 2022, we would have likely seen a far worse market situation. Assuming the consumer continues its strength, I suspect that we will see a recession, but that it should prove a relatively mild recession. In terms of the recession determinants that we saw, all of the early indicators of a recession go red back in March and April of 2020, right here. What quickly followed was the shortest recession known. Looking at where things are now, we are not yet seeing substantial enough concerns in these indicators to suggest a recession is imminent, if you look here. And if you look closely, the first up here at the top, that is personal income, and it's actually improved over the last couple of months. Could the consumer be our saving grace in this economic shift? One has to truly love the resiliency of the United States. All right, we can't turn our heads from the rest of our friends that we share this planet with. International investing was the savior of portfolios throughout the early 2000s, and the redheaded stepchild of portfolios throughout the decade that followed. What we saw over that decade was an accelerated climb in the value of the dollar, as reflected in the purple line on the left-hand side of this chart. A climbing dollar has a negative impact on what is called local currency, or the currency value of investments held in other countries. The chart on the right shows the year-by-year impact going back to 2003. In periods where the US dollar rose in value, the impact is clearly negative on those international investments, not always leading to a negative return overall, but a negative drag on performance. Recently, we have seen a reduction in the value of the dollar versus many currencies, and that has given some international investments room to breathe and enjoy a strong result so far in January. Those two positions I spoke of earlier, they're underperformed as core positions have done quite well and are up double digits in the month of January. Like the rotation from large cap growth to large cap value that we saw a few moments ago and vice versa, we also see a rotation from domestic to international and back to domestic. The most recent run in domestic equities over international has been by far the longest since the early 1970s. This rotation will shift again, and we may see that chance coming in the very near future. Supporting that point is not only the potential change in the value of the US dollar, but also the substantial discount of international equities versus US equities and the higher yields being produced. Both are a full 2 standard deviations from the average, and with the exception of 2008, the strongest they have been in over 2 decades. Earnings growth in the US is still projected to be strong as forecasted in 2024, but the forecast for 2024 in China and emerging markets in general is extremely strong. The thought may be that we should acquire those types of investments in 2024. But remember, investments are leading indicators and will typically respond far in advance of realizing these growth numbers. We have seen far greater attention to China and emerging markets on the part of analysts of late, and we are hopeful that will prove a valuable part of your portfolio if we see the US markets potentially experience less growth as projected by many. As a matter of fact, late last week, Vanguard's projections for the next decade came out, and the performance of international emerging markets is nearly double their expectations for domestic. All right, I want to leave you with two last slides before I share my closing remarks. 2022 was clearly a year to forget in almost every regard. That said, it certainly was not a year that was easy to forget as we forge our way through. I remind you that your portfolio was never intended to be spent in one year and has always been built with the expectation that we would see years like that. The shorter the time period of a portfolio, the more conservatively it needs to be managed. That does not mean that the entire portfolio needs to be managed as if the time period were short. Portions of your portfolio must have exposure to more aggressive investments in order to keep pace with inflation and provide for the longer term. Other portions of your portfolio are allocated more conservatively to meet the needs of the near future. No matter the underlying investment, there is always some sort of risk. Our efforts are to manage those risks for the short term and the long term. And this chart shows nicely the potential return of stocks, bonds, and in this case, a 50-50 portfolio in short time periods and long time periods. Taking into account the markets dating back to 1950, if we held for only 1 year, a stock portfolio could have performed as poorly as negative 39% or as well as 47%. Bonds are quite different than that. From 1950 to the beginning of 22, the range has been a lot tighter, negative 13 to plus 43. If you move this time period out to 5, 10, or 20 years, you can see that the range of performance tightens dramatically. And it's important to keep a long-term view on your portfolio, no matter what age you might be. The reason is that a portion of your portfolio will always be for the long term. And we must work diligently to identify your short-term needs so that they're never at risk. And that leads me to this final slide before my closing remarks. I will keep this short, as pretty much every one of you have seen this slide in the past. And some of you are quite familiar with this, as it is presented regularly for those who are within 2 years of their retirement or later. One of the things I like least about this profession is budgeting. I honestly do not budget at home, and if I did, you would know, because I would probably be single. Instead, what I focus on is how much we save. I know how much we need to save in order to meet our goals. So as long as we save at least that amount, I'm happy. During the years that we're accumulating money, the approach is quite different, yet we continue to diversify and maintain most of our assets in the blue and yellow sections of this diagram. As we approach retirement and the modeling shifts, our income streams come to an end, and we are now dependent on our portfolios and Social Security, and for some lucky souls, a nice pension as well. Given that our portfolios will provide the bulk of our annual need, we have to be clear on what your level of spending is so we can properly build out your portfolio to support your withdrawal needs. We never want to put at risk your spending needs, and by managing your money so that at all times 2 years of withdrawals are without volatility, that money must be maintained in cash, or what we refer to as identifiable cash. Cash or money markets have given us little result in the last 15 years, but we are finally seeing interest rates that are more attractive and have shifted from a mere 0.1% to just shy of 4% of interest being earned on these monies in your portfolio. That will have a positive impact on your overall performance, just as the low interest rates were a drag on your performance if you are near or in retirement. The identifiable cash is the money that comes from interest and dividends and capital gains distributions. Up until that 2 years from retirement mark, those monies were reinvested. And it's important that we change course and have those go to cash, so we're always replenishing your spending needs. I do look forward to discussing this in more detail with anyone who has questions on it. But again, this is a very, very important piece as we approach that 2 years before retirement and from that point forward. All right, next, I want to read this article to you. If America's economic landscape seems suddenly alien and hostile to many citizens, there is good reason. They have never seen anything like it. Nothing in memory has prepared consumers for such turbulent, epochal change, the sort of upheaval that happens once in 50 years. That may explain why so many voter polls taken as the economy shudders toward the November election, reveals such ragged emotional edges, so much fear and misgiving. Even the economists do not have a name for the present condition, though one has described it as suspended animation and never Neverland. At a Time Economic Forum last week, forecasters predicted that US growth would amount to only 1.8% this year and 2.6% for next year, about half the speed of a normal recovery. The current slump already ranks as the longest period of sustained weakness since the Great Depression. That was the last time the economy staggered under as many structural burdens, as opposed to the familiar cyclical problems that create temporary recessions once or twice a decade. The structural faults, many of them legacies of the 1980s, represent a once-in-a-lifetime dislocations that will take years to work out. This is a sick economy that won't respond to traditional remedies, said Norman Robertson, chief economist at Pittsburgh's Mellon Bank. There's going to be a lot of trauma before it's over. How to fix the broken parts of the economy has not only become a central issue of the presidential campaign, but is also likely to stand as a topic A for much of the decade ahead. Quick fixes will not work, a point many Americans seem to be accepting. I actually received this article. I've got the full article if you'd like it, but I received this article from a friend of mine a couple of years ago. And interesting enough, this was published by Time magazine in September of 1992. Pretty incredible. Reading it, you could almost believe that it was obviously written today. And the fact is that there will always be economic problems, government issues, etc. And one of the most difficult parts of our role is to keep folks from overreacting. While there may be times their overreaction may be warranted, that is only evident in hindsight. What is also evident in hindsight is that if we let the overreactions determine portfolio design, and we miss out on opportunities, that falls squarely on our shoulders, and we'll always hold ourselves accountable to that. I started my career 25 years ago this month in January of 1998, and this is not the first difficult market that we've been through, and it's certainly not going to be the last. In my experience in the dot-com bubble early in my career, built a confidence in me that will persist. Last but not least, the 90s brought many investors great confidence in the markets, leading most of us to take substantial level of risk in their portfolios. And the 2000s crushed that confidence and devoured the gains of the 90s for many of those same people. The last decade reinvigorated a confidence in people that had not been seen in over 10 years. In a short 12 months later, and once again, confidence is shaken. We'll find ourselves in markets that build our confidence, but we're also going to find ourselves in markets that require great courage. And these markets are equally important to our long-term investment success. Our approach proved very successful through the 2000s. And while the approach will not always be successful, for instance, in short time periods of unexpected dramatic volatility, we're very confident that we'll be successful through the peaks and valleys as long as we work together with you to ensure your confidence in our process. The greatest challenge will be managing the emotions involved in investing. Thank you for your trust and confidence in our team. Thank you, everybody, though, and look forward to speaking with you, seeing you on Zoom, or seeing you in person soon.